Hi, and welcome to another episode of the Innovation Conversation. Today we are joined by Lance Cottrell. Lance, welcome to the podcast.
Thanks for having me. It's a real pleasure.
Pleasure having you here. Lance, would you like to introduce yourself to the audience, please?
Sure. Yeah. So I'm an exited founder. I started my first company in 1995 when I dropped out of my PhD in astrophysics and created the world's first internet privacy company. After the dot-com collapse, we managed to survive that and pivoted into working for the government and ended up building platforms for conducting online undercover operations for the national security community. After that, I became an angel investor and got active in advising startups, which is where I'm at now.
Okay, so you know all the government secrets. That's actually quite interesting.
That's right. That's all compartmented, but I know my secrets.
Interesting, very interesting. So it's quite interesting because your career spanned many decades, but you've actually been through the dot-com bubble and now the latest one. So what lessons and tips and tricks can you actually give to the entrepreneur right now and just say, hey, you know what, I've done all these mistakes, don't do them.
I think that one of the big things to watch for is getting too hung up on the cyclical nature of, these boom bust cycles. Obviously, the big thing that it impacts for a founder is fundraising. Right? It's going to be much more difficult to raise that next round as things are getting difficult. Conversely, that tends to be when the best companies get founded, right? It's in hard times. It's not a boom where people are all chasing the hot, flashy thing of the day. That's the chance to make those really strong, lasting companies that are going to grow through that. So I don't worry too much about it, but you always want to be thinking in terms of raising more money than you think, giving yourself more runway, and really being cautious about cash management because running out of cash is what kills most startups.
I'm always curious one thing, from your perspective, because you're also an entrepreneur, but now an investor. What's that one pet peeve you have against all startups? And you look at them and say, you know what, I'm not going to invest from the get go.
The thing that drives me the most nuts is over focus on the product, where people are just super excited about their technology and the feature set and what they're doing, and don't spend nearly enough time looking at their customer base and the benefits they're providing and whether they can reach them and doing all those experiments to see if they build this tool, do people actually want it? Because building things is the technical founder's happy place, right? It is their comfort zone. That's where they want to go by default. And it's so important to pull back from that and spend a lot more time talking to customers and really testing out your hypothesis about what they want.
And what do you think makes a startup successful? I mean, I know there's many factors, but what's that one thing you kind of say, you know what, this is going to work?
I think it's when you've tested and iterated and run your experiments and you get to that spot where you feel the change from the push to the pull. When you go and talk to a customer, it's not like, "Hey, let me explain why this works and here's why you should want it." And suddenly you're at the spot where as soon as you start talking to them about the way you solve their problems, they say, "Shut up and take my money." Like, stop selling me. I want this. When can I have it? That's when you know you're onto something that I think can be really successful.
I'm guessing you get a lot of pitch decks, probably way too many to even count them. How do you manage all that? And what makes a successful pitch deck? What makes an unsuccessful pitch deck? And also, what's the best way to actually reach out to an investor in your perspective?
So a good pitch deck really needs to give me a sense of what kind of business you've got. I see a lot of people who want to give me a teaser deck, which is just going to give me a hint of what they're doing.
Mm-hmm.
I'm not a fan of the teaser deck because I really want to be able to make a decision right now about whether it's worth having that follow-on conversation. Does it look like there's something there that is going to be worth my time? Because, as you say, I get a lot. I'm going to guesstimate I get well over 1,000 pitch decks a year.
Oh,
And I've got a lot of other irons in the fire, so it's not what I spend my time doing. So I have to make some very quick triage decisions. So one of the keys with the pitch deck is to make sure that it can survive a 1 minute scan, so that I'm just going to look through it, flip through the slides, look at the headlines, maybe glance at some graphs, and I'm going to very quickly say, is this worth spending 5 to 10 minutes on, or can I just round file this and move on to the next pitch deck that I've gotten? That's going to be one of those real keys. And so you need to be showing me all those key aspects. And it really isn't slides of your user interface. It's, here's what we know about our customer base. Here's how we've tested that we can reach them, that we know what it costs to sell them. We understand our CAC or our sales process or timelines. We validated all the things about the model. Because as an investor, I don't want to fund science experiments. I want to play T-ball. I want you to have everything lined up and you just need money to put your foot on the gas. That's the kind of thing I want. And your deck needs to show that.
Hmm. And how important is the team for the startup?
Team is critical because I know you're going to pivot. I mean, look at my scenario. I started off doing consumer privacy and ended up doing undercover government spook stuff. Utterly different. So what you're really betting on is this group of people's ability to execute on what they're doing. And typically it's usually the same broad area, right? Someone's not going to go from medical devices to dating websites or something like that. So they need to have the core capabilities, experience in this general space. But then I need to believe that they understand how to run a business, how to grow a business, what their strategic insight is that makes them different from the other people who are trying to solve the same problem. Because there's always going to be others that are out there. And so, yeah, the team is the most important thing because who knows if what they're going to end up doing will resemble that pitch deck at all.
Now you mentioned something quite fascinating, which is the ability to pivot. Now we all know that a lot of successful startups actually end up pivoting from their original idea, and rightfully so. Does that scare investors off, or actually that's reassuring?
We need to believe that you have the right kind of mindset to do it because the odds are high that your initial guess about the product you need to build and exactly what your customers want is wrong. Right? The odds are very high that you're wrong about that. Maybe a little bit wrong, maybe a lot wrong. So I need to believe that you have the flexibility of thought to recognize when you are off course and make that course correction. So there's a phrase I like to use. I describe it as strong convictions loosely held. You need to be extremely focused on what you're doing. You need to be passionate. You need to believe in it. And you need to be willing to let go of that and walk away as soon as the data shows you were wrong.
In all your years in the market, what was, I guess you can kind of pinpoint probably the key things you always do in a successful startup, the key things you always see founders do. What are they? What does that look like?
I think it comes down to experimentation because every startup is unique, every market is unique, every moment and opportunity is unlike every single other one out there. So the two things I think that really need to be happening is test, 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 test. Your intuition is usually terrible. I can think of lots of examples where I was absolutely convinced I knew the way to market my product, the way to sell it. This was going to be a home run direction to go. And it turned out I was totally wrong. And then others that I had no idea were going to be all that valuable, but I tried them. They looked like they had potential, and those ended up being huge for me. So being able to do those sort of continuous tests and, don't bet the farm. You see some area over there that looks like it may be greener grass that might be a better opportunity for you. You don't want to shut down the thing that's keeping your lights on right now to go chase that, but you don't want to ignore it either. So how do you dribble enough resources to make a really lean and efficient test to understand, is that where you want to go? And then start pursuing it. I mean, when we started the government space, it was a tiny corner of what we did. But pretty rapidly, we discovered that those were big contracts. We could close them reliably, and it accelerated to be 90% of our revenue in about 3 years.
Well, and in terms of the mindset that it takes to actually build a successful business, what do you think that actually requires? Because a lot of people talk about being super resilient, having a lot of grit. From your experience, what does it actually take?
A pig-headed stubbornness. Grit is a lot of it because there's so many really, really difficult times. You're going to run into challenges. You're going to be facing obstacles that feel insurmountable, and you need to be willing to sort of do whatever it takes to go over, around, through those obstacles to get to the other side. Often those are creative approaches. I actually find a mistake a lot of founders make is early on, they'll start to hire in corporate people with amazing backgrounds and fantastic resumes who haven't done the startup thing before. And their default approach to solving problems tends to be hiring a really good team, bringing in some expensive consultants and pouring money on it. Whereas with startups, it's got to be, all right, there's 3 of us in this room and we have what's in this room with us today. How do we get there? And it's scrappy, it's creative, it's sometimes a little extreme in some cases, but that's the sort of approach you need to be taking.
In your own journey, when you were dealing with obstacles, what were you saying to yourself? What was that thing in the back of your mind? Was it like a quote or a saying? What would push you forward? push you forward.
So we often called it the cockroach strategy. There's that sort of joke that after the nuclear holocaust, the only thing that'll survive are the cockroaches walking around. And so to some extent, especially like during big downturns in the economy, we thought about that a lot. Like, how do we just survive this? Because at some level, you can't win if you aren't alive, if you're not still in the game and still playing. And there are always new opportunities, new lucky happenstances that come along that you can't execute on if the company has folded. So we spent a lot of time just focused on how do we survive another week, another month, another 2 months, just keep it rolling forward. During the dot-com collapse, we probably spent 18 months with less than 30 days of working capital in the bank. We were right on that edge. And so you're squeezing every penny. Every investment you make has to have immediate payback. But it allowed us to continue to grow the company. We grew our way out of that pit that we were in. We weren't going to get any funding at that point, and discover this new opportunity, which then allowed the company to hockey stick and explode.
And how do you manage all that stress? Because it's a lot of stress on you when you're at that stage.
So I think there's a couple of things. Having co-founders or other members on your management team that you can be completely honest with is critical. You need to have someone where you can have these tough reality conversations while you're trying to put on a brave face for your team, for your investors, for your customers. You have to be able to have that kind of real world outlet. And then personally, it was physicality. I was taking Kung Fu at the time. And so being able to a couple of nights a week go into our school and yell and hit things and kick pads and whatever else was hugely cathartic and allowed you to then get back in the next day. Meditation, a lot of that self-care stuff, like don't drive yourself 100 hours a week every week for years on end. You have to have that balance because it tends to be a marathon, not a sprint. During a crunch time, you're trying to deliver a version of the product, you can sprint, but you have to then fall back to a maintainable pace where you're getting a good night's sleep, you're exercising, you're eating well, you're taking care of all those other systems that allow you to be working at peak performance.
Now, there's a lot of controversy around what actually founders and investors should say to each other. Right? Founders are always a bit afraid of they're going to scare the investors off. From your experience as both a founder and an investor, do you think honesty is the best policy, or do you think people should just fake it till they make it?
I think you definitely need to be cards face up with your investors, and the investors should be equally honest with the founders they're working with about what their intentions are for ongoing support or follow-on investments or all of those things. On the founder side, there is nothing worse than having me find some skeleton in your closet during due diligence. Because once I write the check, assuming I'm a fairly minority investor, I lose all my power. Right? As soon as you cash that, I can kibitz, I can sort of talk to you, I can vote my shares, but that's not going to move the needle. I'm trusting you to act in my best interests. Anything that suggests that there's something squirrely or hinky about what you're doing is going to make me run for the hills. Which is not to say you have to focus on your dirty laundry, right? I expect you to be optimistic. We're looking for best case outcomes. You should be bullish about your total market opportunity, how big this can be, where you're trying to go, the strategic vision you have for the company. That should all be bold. And you need to be realistic about how you can get there. And if you have weaknesses or issues, you should be looking for help in how to address them, right? If you've got a hole in your team, don't try to pretend you don't. Say, hey, we need help from our investors to fill this thing. Or, we're looking to line someone up. That's our next hire as soon as we get this funding. Whatever that may be, try to make it part of a partnership. My investors and my board of directors were a thorn, right? I mean, they asked a lot of hard questions. They put us on the spot. They really put our feet to the fire and whatever other analogies we want to use. But they were always in our corner when they were doing it. And it was incredibly helpful. And it really helped us stay on target because you can kind of, start believing your own hype sometimes. And having the investors, having that board that sort of makes sure that, no, have you validated that? Can you prove that that's right? How have you tested this idea? Super valuable to have.
And, coming in from Europe, and I know you're based in the US, there's always a massive comparison between the two ecosystems. So what do you think makes the US so successful for startups? Because there's so many great businesses coming out of Silicon Valley, which is impressive. So what do you think makes that ecosystem so special?
I think it is more focused on the hope and less on the current economics. I see when I work with a lot of European startups, it seems like the angel investment and early stage VC community is more focused on the financials. Whereas in California, the thought is generally you're going to raise a bunch of money, you're going to lose money for quite a while. If you can get 10 million, 100 million active users on the service, or 5 million SaaS customers, we will work out how to make money with that. The question is, are there enough people who want the thing you're doing to allow you to grow to that size to be able to execute on it? And that tends to be more of the Silicon Valley and writ large the US venture mindset around this. So it's easier to raise, it's easier to raise bigger. It tends to be more founder friendly as well. I often see fairly founder unfriendly terms being offered by European investors and very concerned about downside loss prevention. Whereas in America, it tends to be, I know a lot of my investments are going to zero. I'm fine with that because I'm working really hard to have a couple of companies that are going to return 100x for me.
The next question is obviously how do you manage risk? Because there's a lot of risk involved.
Numbers. I mean, I think at some level it is a statistical game. As an investor, I'm looking to make a large enough number of investments across a diversified number of companies and spaces so that I have a high probability of having a couple of those big winners in there. And then the process becomes more about trying to avoid the losers, right? Looking at the company to say, does it even have the potential to get there? Looking at the team to say, do I believe these are the people who can absolutely kill it? Because a mediocre team is just not going to cut it. The startup process is so incredibly difficult. I'm looking for those few people who I believe, even if there are 5 other companies trying to do the same thing at the same time, these are the guys who are going to win. And so putting the thumb on the scale is critical. But the assumption is this is an incredibly high risk space. We're going to have a lot of losers in there as well.
And when do you call it quits? When do you say to the startup, you know what, this is it. This is the end of the road.
So it is incredibly
It's a tricky
important.
one.
Yeah, it's incredibly important not to chase things down. So I think the sunk cost fallacy is the huge issue with this kind of investing. So at each round, and it's not easy to do, but at each round, you really need to take a step back and say, if I had never put a single dime into this company, would I invest in them now? And if the answer is no, almost certainly shouldn't be doing a double down on that company. You'd be far better off taking that same number of dollars and putting it in something with a chance to win. Because it tends to be the case that you're not going to save the company and turn it into a radical success. You're just delaying disaster and stretching things out into a long, death process. Whereas it would be far better as soon as you realize this isn't going to work, either pivot or shut it down and start another company, return some capital.
And how do you look at founders who have been unsuccessful in the past?
Actually, I want to look at why they were unsuccessful. I think that's incredibly valuable because there's a lot of ways that companies can fail. It could be that their hypothesis just turned out to be wrong, or a major competitor that they didn't expect arrived and things went the wrong way, right? It usually happens that it doesn't work out. As long as they didn't fail because they were stupid, then it's a fantastic learning experience. Most successful founders have been unsuccessful founders. Having been through the process once or twice before makes them so much more aware and savvy about the things they didn't do the first time. What are the priorities they need to focus on? Because this is one of the fundamental problems of being a first-time founder is suddenly you're an expert on whatever it is you're an expert in that's causing you to start this company, right? Usually you have a high level of skill in something, and it isn't running startups in almost all cases. And so you've then got this strange situation where you've got to learn everything about everything all at once. They're highly technical subjects with large implications for the success of your company. That's a completely unrealistic and unreasonable ask, but it's just the way the world works. The second or third time founder at least has been through that meat grinder a few times and understands, okay, this I can ignore. Here's where I should focus. These are the priorities I should be going after. Here's the order in which to execute on things to make maximum use of the cash that I have available, right? All of those things are far better in a multi-time founder as long as they have been mindful each time and are learning from their experiences.
And tell me one thing: what keeps you motivated? What gets you out of bed every morning and just say, "I want to, do things"?
Yeah, I think when I was actively in my company, it was really about the mission that was the most important thing to me. Right? I cared about the work we were doing. I really cared passionately about privacy. When we were in the national security space, I had insights into the kinds of things they were using my solutions for, and they were important. There were lives that were saved because of the technology I was deploying. That gets you up in the morning, right? That really gets you going. And then, of course, the team as well, the people you're working with, the energy that you have wanting to build something that supports them. I can't tell you how rewarding it was when we finally hit our exit. And there was a substantial payout to everyone who'd been working on the team, who got their options, who was part of that process. And that was really rewarding. And these days, what gets me out of bed is working with founders. I love doing advising and coaching around that early stage process as they're really starting to coalesce and build out that business, define what it is they're going to go after. That's just a super exciting time.
So, what advice would you give to a founder that's just starting out, for example?
I think
This is quite a broad question. Obviously, there's a lot
Yeah,
of stuff.
absolutely. But it really comes back to testing. Don't start by building, start by doing investigation and research, talking to customers, doing surveys, putting out some quick mock ups. Really explore why your customers need this, what they need. Why aren't there other solutions that are out there? Is there a demand to pay for it? Are you a priority? This is a huge one. A lot of people will go and ask a customer, would this be valuable? Could you use this? And the answer is often, yes, this would be a great thing to have. It would save me some money. What they don't ask is, if this was sitting on the shelf, would buying and implementing this be the next thing on your list of priorities? Because usually the answer is no. I've got like 8 things that are causing my house to burn down right now. I'm going to deal with those. Yours is a nice to have. I'd love to do it, and I'll get around to it in 8 years when I've got the rest of my priorities out of the way. And so then they've gotten all of these yeses from potential customers. And when they build it, they go back to them and say, hey, do you want to buy it? It's like, not right now. Right. They get happy ears with the responses they hear. So really digging into what are going to be the problems? Do they have budget for this kind of thing? Can they take it on? Like ed tech. I see so many ed tech projects, and they're doing important work that really needs to be done in education. And schools have no money. And they have thousands of people trying to sell them things. It's brutally hard to sell into school systems. And they haven't really explored that to understand, how do they fit in? Do the schools have budget for this? Is this a priority for, do they know who in the schools has the decision-making power? Because often they'll go talk to teachers. The teachers are all thumbs up, but it's the superintendent who pays for it. And the superintendent, that's not their priority. So it's never going to get bought. Right? All of those secondary things need to get nailed down before you even start the process of actually building the solution. This can avoid enormous amounts of waste and heartache and time and lost money. Do that groundwork first.
Do you think it's hard selling to government, both local and federal?
Yeah, selling to government has its own special flavors of brain damage. It is really strange. Local government tends to be radically underfunded. That's the problem there, is they often just don't have the money that you'd like. Federal government, it's all about the bureaucracy and procurement processes and timelines. So, you go in and start talking to them today, and it may be 18 months before you get something. Or the thing you want to bid on came out in this huge request for proposals, which is highly technical to respond to, requires a lot of experience. You're some small company. You probably need to be partnering with one of the big systems integrators, which you don't even know how to do. You've never heard of these people. It's a long time to get in there. We were sort of lucky in that we were moving into a greenfield space. The government had never purchased anything like what we were doing before. Our challenge was to convince them that legally they could. They were allowed to outsource the stuff we wanted to do. But from there, it was all sole source contracts. So we were working directly with the people who were going to implement it. We're selling to the people who are owning the mission at the tip of the spear, not the IT department, not the back end. So we had sort of the best case for selling to the government. And it's still a nightmare.
I can imagine. There's a lot of talk nowadays about AI and blockchain, and it feels that every startup I come across is either doing something with AI or in the blockchain. Now, is this an absolute necessity? Do people actually need to start building something on it with AI or in the blockchain? Or actually, there's still plenty of room to grow in other areas?
So there's always a huge number of areas out there that people can build into. And some of my favorite businesses are the least sexy. You discover that there's some huge unmet need in a big market that is, at some level, incredibly boring. And that means that there aren't 20 other startups trying to go after it. There's not every VC looking for somewhere to dump money on to launch this product. that can be a really big advantage, giving you room to grow, room to learn, some time to execute before the space gets filled up. So I think always worth looking for the size of that opportunity, not necessarily chasing the latest shiny, because by the time you start seeing it covered on the news or it's all over Reddit or whatever, you're probably on the wrong part of the hype cycle. You wanted to be in 6 months to a year before that when this was just starting to grow. Now, if you start, all those companies that were early adopters have a year head start on you. You're going to start working on your product and then see a dozen competitors actually launch with theirs, right? So timing is really critical.
And how do you as an
I
investor?
want to touch on AI though and
Yeah.
blockchain real quick. I'm highly dubious of most blockchain startups I see because they seem to be buzzword compliant. They are implementing a blockchain for things where a simple database would be far more effective, cheaper, and faster, but they want to be able to say they're using a blockchain. Blockchains are incredibly powerful for certain applications, but I find they're misused most of the time. AI, on the other hand, in some ways, I think most companies that are using AI shouldn't talk about it because it's rapidly becoming table stakes. If you are a software company or a SaaS company or a software service provider and you're not using AI in some way, what the hell's wrong with you? Right? Of course, you should be using AI. It's like saying, well, we've got a website. Obviously, you've got a website. Obviously, you're going to use AI. Obviously, you're going to use programming tools, or if you need an app, you're going to have an app. Those are aspects of how you're doing what you're doing, but it's the business that is being enabled by the AI that matters. This is with the exception of some deep tech companies that are doing really interesting things in AI or the foundational models, but those are few and far between. Most of them are actually just using AI in what they're doing. They should back off on how much they talk about AI.
How do you find opportunities? Or do they just come your way, or do you actually go actively looking for them?
So I'm not doing a huge amount of active hunting right now. I am active in an angel group. So we have applications coming in there all the time. I actually run our selection committee. So I get to see all of the companies that come in very early. So that's a great source of deal flow. Of course, I just list that I'm an angel investor on LinkedIn. And so that generates something like 1,000 a year. I'm in a couple of early stage funds. And those are the people who really have time to do the prospecting, right? They're going out and beating the bushes. They're looking for all these opportunities. They're going to the mixers and meeting people. And I live out in the boonies and I'm too lazy. So I'm not great about hunting down the opportunities. But that really is the way it works if you want to be successful as an investor.
Yeah, and I was just thinking, for a startup, what do you think actually works better? Is to actually go face to face or send a bunch of cold emails?
So if you can go face to face, that's always great. It's always better to have sort of that personal connection. Suggest doing pitch events.
Mhm.
Go into the city and get in front of potential investors. Even if these are not, maybe especially if they're not actually fundraising events, right? They're more about visibility, practice, feedback, things like that. You really want to hone that pitch. But those are great ways of meeting people. I also strongly encourage people to reach out to potential investors for feedback and advice well before they're fundraising. It's never the best look when the first time I hear from someone is with their hand out. It's not really what I want. Whereas if they come to me and say, "Hey, I'm in this space. What do you think about this space?" Or, I'm looking at this from this direction. What's your take on that?" Or even, what are your criteria for investing? I don't even want to bother you if I'm not in the right spot, or let me know when to get there. Those can get the ball rolling. The simple questions, something that only takes a few seconds to respond to. You're not asking for a half hour of my time or anything like that. That can then establish that connection. You get me on the update email list. So I'm getting pinged on a regular basis, reminded of what you're doing and that you're accomplishing things. So then when you're ready to fundraise, you can reach out much more likely to get success. But certainly cold outreach is going to be part of that. You're not always going to be able to have a connection. It's just a numbers game, right? You're going to be sending probably thousands of cold outreaches and making hundreds of pitches before you close your pre-seed round.
And do you invest outside of the US or just focus on the US?
So personally, I am only in the US because that's the market I understand for direct investments. So some of the funds I'm in do international work, and I've also invested internationally through some syndicates because I can then rely on someone who has deep cultural and geographical knowledge of the area in which they're investing. And I'm basically piggybacking on them. I also tend to write smaller checks there because I have a lower level of confidence. So I'm taking a bit more of a shotgun strategy, but largely I'm backing the syndicate lead as the horse.
There's a lot of, I know a lot of startups who raise seed funding and then decided to go for Series A's in the US. Do you think that's the correct approach, or actually it's a complete mistake? They should actually try and raise in their local geography.
I think by the time you're hitting sort of Series A, it definitely makes sense to be looking at the US. I think as you're getting into those larger, more institutional investors, they're all global at that point. And so you want to go with the investor who's most aligned with your thesis, who can bring the most strategic value to what you're doing. The fact that they're located in your backyard and you can, have a meeting with them over a beer or a coffee and get some advice starts to matter less and less than their ability to connect you to major partners and hook you up with the big investors you need then in your B round, C, D, E, and so forth.
Now, if we could go back in time and you can go back to yourself in, I don't know, 1995 when you just got started, what would you tell to yourself? What would you say? You know what? Don't do this or do this.
Yeah, I would have spent more time working, finding advisors and trying to work with them. I mean, the ecosystem, of course, was radically different back then. It has improved so much for founders, but I really didn't understand how much I didn't know at that time. I was an astrophysicist. I was an astronomer before I started the company. I had no background in this. And so I was just trying to work it out all on my own. But yeah, I think more testing and validation would be what I'd tell myself is I made a lot of assumptions about what would work and we sort of went in exactly what I tell everyone not to do. We doubled down on developing things too early and not testing enough. Those are the sort of things I'd go back and tell myself that, and surrounding myself with the right people to really counterbalance the weaknesses in my own background.
And having that type of background, do you invest anything related to space, or you actually moved away from that?
I've done a little space. I've done a little cybersecurity, which is sort of what my company ended up being. It's ironic. I think in some ways it's harder to get an investment from me in areas that I know really well because I can see all the weaknesses and problems, even though that's probably where I should be concentrating all my investments. Space is a tricky one just because it's got such a long time horizon to pay off. These tend to be very speculative kinds of companies, but with potentially gigantic payoffs.
Now, I always like to ask you a little bit of a personal question, which is, what's the last book you read?
The last book I read,
The last good book you read, which is probably
yeah,
not.
so I think I just finally, I was late to the party, but I just read Nudge, and I really enjoyed that.
What was the biggest insight from Nudge?
So just the level of impact on choice architecture and how you design forms or intakes or what kind of defaults you use can have a huge impact, ideally for the good, but they're also manipulable in many ways. But just really thinking about that kind of removing what they also call sludge from processes. Right? We've all downloaded an app where you start some new service and immediately there's friction in that experience. You're having to fill out forms, you're having to do things, you're having to provide and answer emails and do all sorts of things. And that tends to make you fall off. So I think one of the insights there is how clean can you make this? How much can you remove the obstacles to moving in the direction you want people to move?
Definitely want to add to my list. Lance, if people want to reach out to you, what's the best way of doing so?
Probably the best way is on LinkedIn. I'm Lance Cottrell at LinkedIn, or through my website. I've got a huge amount of content, free content for founders on YouTube and on my website. They're both Feel the Boot, feeltheboot.com and Feel the Boot at YouTube.
Thank you so much. Lance, it's been an absolute pleasure having you on the podcast. Thank you for your time.
Thanks so much. It was a blast.